All right, Bulls and Bears back with another dose economic reality. It is Monday, March 17th, 2025. It's St. Patrick's Day. Happy St. Patrick's Day. Shame on me. I was going to wear green, but then I was thinking, why would I wear green for a holiday that I don't even know where it originated from, right? So we're going to get into that for a minute here. We got a lot of economic news to get caught up on. Unbelievable news, so stay tuned. The economy is about ready to take a insane direction, and I think most of you probably already know where I'm headed with that. But St. Patrick's Day, let me just show you where it originated. I used to really not look into this stuff, right? And I've got some relatives that are religious, and I'm kind of religious too, but they're really religious. And they kind of started telling me about some of the origins of these holidays, like, oh, this is a pagan holiday, and this originated from this occultist practice, like weird, crazy stuff, right, that I never imagined. St. Patrick's Day, let me just give you the description here, is a religious and cultural holiday that commemorates St. Patrick. Okay, I didn't know who St. Patrick was. Why was I wearing green for somebody I don't know? Who's St. Patrick? The patron saint of Ireland, and his role in bringing Christianity to the country in the 5th century, though he was never officially canonized. Now, I'm part Irish, and shame on me. Again, I should have known that, right? Here's more detailed look here. Wikipedia put it as follows. The Feast of St. Patrick. The day is a religious cultural holiday. What did it say here? To celebrate Christianity's entry into Ireland. Interesting that we celebrate that. And it's pretty wild. I've got friends that used to really go crazy with this holiday, and they used to like dress up. You see this picture here, not as crazy as that, but they used to dress up, wear green. And I had a friend who drank green beer. Speaking of that, real quick before we get into the economic situation here, today's report, Chicago River was just dyed green. And I'll be honest, this is kind of weird. Look at all the people watching this. And what's the point of this? How much does this cost? Are Chicago taxpayers like okay that they probably paid for this? Look at that. And what the heck is it? Is it safe? Is it toxic? Chicago River dyed green. Why? Why can't you just shine green lights on? What's that in Las Vegas? They have the water show and they shine all these different lights. It makes the water look like it's changing colors when they shine the light on it. Why not just shine a light? What the heck are they dumping in the river? There you go. Chicago River. What are your thoughts on it? Waste of money? Is it shady? Kind of weird? I would say all of the above. All right, people, let's get into it. A new week. A new chance to invest. A new chance to make money. Or be defensive, be cautious, because now is an insane time, folks. Look at a 6-month chart here in the stock market. You can see we've erased all the gains from the past 6 months. This is the S&P 500. With the recent bounce that we saw on Friday, we got close to where we were at 6 months ago, but a lot of pain for people that got in here over the past couple months. They're down bigly. People that didn't get out are seeing big hits taken to their stock portfolios, to their retirement accounts. And I've been cautious for months here, folks. Ever since November, all the new actions that are being taken by this administration, I knew it was going to cause, and I think most of you knew as well, I knew it was going to cause not just volatility, but a lot of uncertainty. And I think things are going to get a lot worse before they get better. You can't bring back jobs that quickly. It's going to be a long, long process. I think at least a year probably before you see many jobs actually come back. That is if the tariffs even work, and the debate is still out on that. And the administration even came out and admitted that this could be inflationary, that people are going to have to go through basically a rough patch before they start seeing the better economy or the benefits. My question is, will the benefits even get here in the next 4 years before everything gets flipped back in the other direction? You know what I mean? In 4 years from now. So pretty crazy times, folks. The stock market, we're going to see if this market recovers. Remember, the stock market is driven by the top 10%. Top 10%, mega wealthy corporations, individuals, also billionaires, control this market. They own 93% of the stocks in the stock market, folks. So when the market sells off, when it goes up, when it goes down, it's controlled by less than, 10% of the population approximately. And when you see a sell-off happen, the 10 percenters aren't losing money. The market's going down because the 10 percenters are selling, right? Because they own most of the stock market. So they're getting out. The ones left holding the bag is the other 90%, right, who don't control the stock market. And that's why I mentioned a few minutes ago, the average Joe's taking a big hit to their portfolio, a big hit to their retirement accounts, 401k, etc. Some people moved into a steady payout in their retirement account, such as a money market, similar to like a CD where you get like a percentage return, APR, APY, annual percentage yield. And some of them up to 5%, which is not bad. Just no risk, just sit and get 5%. T-bill and chill, as they say. But moving on here, folks, we've got the consumer side of this, which the consumer, we heard for many, many years that the consumer made up about 70% of the U.S. economy with their spending, consumer spending. What we found out last week is that it was the top 10% of the consumers that drove about 50% of that economic growth, which they put in the category of GDP, gross domestic product. So if it weren't for the mega wealthy of the top 10%, these economic numbers would look really, I mean, they already look bad, but they would look really abysmal. U.S. concerns as U.S. consumers starting to crack as tariffs add to inflation and recession concerns. That's how CNBC put it recently. CEOs of strong companies like Delta, Walmart, Dick's Sporting Goods, and more have struck cautious tones in recent weeks, leading them to cut their guidance or give weaker than expected outlooks. We also heard from the CEO of Starbucks and the Dollar General. The Dollar General recently closed over 100 stores or announced 100 store closures. So we're seeing a lot of these retailers are bracing for impact. We're going to see how it plays out, but things are really uncertain right now, and a lot of people are being, one, cautious, and two, kind of fearful. I would say don't be fearful, because we've seen this coming a long time ago. I mean, if you've been on this channel, you knew that a lot of uncertainty was headed our way. So a lot of us are sitting pretty right now. We're eating the popcorn. We're sitting back. We're relaxing and seeing how this all plays out. And just in the most recent survey, we saw consumer confidence take the biggest drop in over 2 years. And a lot of consumers, even that don't really pay attention to this type of news that we do here on this channel, are really starting to kind of peek their heads out of the sand, I guess. And at a time when they're already in so much debt, now they're worried that our prices are going to go even higher when they're barely scraping by, with most people living paycheck to paycheck. And then you hear stories like prices are going to go up even more because the tariffs. It's all over the headlines. Even people that aren't into the financial economic news, typically it's on all over the headlines now, not just economic news, but just the news in general. They're talking about it. People are starting to kind of pull back on their spending and be more cautious. And speaking of investing in the stock market, folks, Nvidia is down 20%. What did I tell people right here on this channel? We showed you that chart where it was going like this, and then all of a sudden it was whoosh, and people were saying get into the stock after it took a huge like run up of like 100 or 200% in the past like year. And I told people to be careful. I was even going on a put option, betting that the stock was going to go down, and I actually closed my position out kind of early. I made some money, but if I would have stayed in that position longer, I could have made more money. But I think that was a no-brainer, folks, the way that stock ran up. And now you see lots of stocks selling off, and the uncertainty is not actually close to being finished. In fact, I think it's just getting started, because we haven't even seen the impact of any tariffs yet. This could be months, could it be years? We'll have to see how it plays out, folks. But I'm going to be cautious until I start seeing some noticeable confidence reemerge into the economy, with maybe manufacturing coming back, with maybe price levels coming down. And you still have the debt levels, though, right? Prices coming down doesn't erase all the debt that people are in right now. So I think the spending is still going to be subdued, even if you see the cost of living come down, groceries, eggs, even gas and energy. If it comes down, I think the consumer is still going to have a tough time. All right, moving on here, folks. Speaking of prices coming down, we always have to bring up the housing bubble, the bubble that seems like it's never going to deflate. It's been years since we passed the 2008 price levels, when home prices peaked in 2008. Then we saw 2009, 10, 11, where prices actually corrected pretty severely in some cases, including, I believe it was about 50% price corrections on homes here in California. But now we're not seeing a drop. It seems like the bubble's just being inflated with more easy money, loose lending policies and more, and a lot of billionaires buying homes too. But look at this here. What's happening with realtors? And the Times reported this: home sellers and buyers accuse realtors of blocking lower fees. Remember, we heard about it's going to be the end of so many realtors because now the 3% commission is gone, or 6% commission. A year after the landmark settlement called for a disruption in how real estate agents are paid, people say they still feel forced to pay them excessive commissions. So these realtors are still pressuring these people to still give them the higher commission. And I think they're making them sign agreements that have the higher commission on them. And people, I don't think they want to look around, or they don't want to insult the realtor or something like that. But when Mike Chambers was ready to sell his house in Boulder, Colorado last month, he interviewed a handful of real estate agents who promised he could fetch, $2.75 million, but the promise would come at a cost. Each agent wanted him to pay a commission of at least 5%. So what they're doing is they're saying if you want the top price on your home, then you're going to have to pay the higher commission. And realtors are already in trouble. We've already seen tens of thousands of real estate agents pretty much drop out of the industry because of the slowdown in sales. And with the sales volume so low, now the ones that are still selling homes, they're still getting pretty good because they're still, sounds like, pressuring people into paying these higher commissions. But if it weren't for that, how many more real estate agents would we see drop out of the business entirely? And it's pretty interesting the way it works, because for years, realtors were loving the high home prices because obviously higher commission with the higher home price. But then home prices get so high and so unaffordable that the transactions drop, the sales drop, and the volume drops. And then you have the same realtors that were rooting for high prices because high commissions now getting out of the game because they're not making enough transactions. So it's pretty interesting how it works. All the euphoria up until things completely implode or collapse. What we've yet to see, though, is a collapse in prices. There's people out there saying that this housing bubble is never going to go bust, that home prices are never going to come down. Well, if you think that, I would encourage you to look at what's happening lately. Look at all the disruptions and all the changes in the economy with the layoffs and everything else that we're seeing, right? So I think we're going to see some major economic changes coming up here in the very near. They're already here. I mean, every day we report new developments and changes in the economy. It's happening every day. But as far as price levels, I think we're going to see a whole new world here within the next year, including in the housing market. I'm not sure if it's going to be a bursting of the bubble, but I think we're going to start seeing some impacts to home prices with all the stuff that we're seeing happening right now, and it's just getting started. And we're going to talk about that in a little more detail here in just a few minutes. And actually, this week, we've got a central bank Fed meeting, and they're expected to hold rates steady. I would agree with that. I would say that's not a time to be raising or cutting rates. Actually, I think they should raise, but I really don't think they will. But I certainly don't think they're going to cut because of the inflationary pressures that really are here and have remained, but are likely to get even more severe. So they should raise rates, though, because if you want to bring inflation down, you've got to raise rates. I thought they should have bumped rates up to 10% immediately after we saw the runaway inflation that we saw over the past few years. But of course they didn't, because they didn't want to crash the economy, because if that would have happened, you would have seen the economy come down in a hurry, because that would have been so much more stress on the average household. Imagine credit card interest rates that already jumped up above 20% with a 10% Fed funds rate. Who knows where those interest rates would have went? Maybe even 25%. I mean, nobody knows exactly, because we've never seen that rapid rise, that rapid of a rise in interest rates. But yeah, this week, I mean, what do you think? The Fed's going to hold it steady as far as I can see. And when you look at it, the real moment of truth is about to begin, right? We've only so far really seen the fear from the announcement of what's going to happen, right? The economic uncertainty, the consumer plunge in confidence because of all the talk of the cuts. But we haven't actually seen the impact of the cuts yet. In fact, this week, agencies have to announce their plans for downsizing and getting rid of all these people. The Department of Education, for example, is now moving forward with their proposal to eliminate nearly half of its workforce. The Department of Veteran Affairs, reduction of 80,000 employees. Social Security Administration, they're offering buyouts ahead of this reduction in workforce. So I think they're going to try to do it where they're going to try to buy people out and not do it all at once and give people sort of a period to try to look for a different job. But these are better than average paying jobs, right? When you look at this, and this number of people getting let go, it's definitely going to be impactful on the economy at a time when consumers are already pulling back on spending and being very cautious. And of course, people transitioning into a new job, they're likely to be also very cautious on their spending. And how's it going to impact the economy, especially when, like I said before, this consumer is propped up on largely on consumer spending. And a story that I just ran across here this week. Americans living paycheck to paycheck, still on the topic of consumers barely scraping by, paid $39 billion with a B, in junk fees. And these credit card companies, basically every time you swipe a card, they're taking a cut of the transaction that the business owner has to absorb. And sometimes they'll even charge you for using a credit card. My local barber charges, I think it's $1 to use a credit card. So I always go in there with cash. And we've got more businesses now asking people to pay with cash so they can avoid these fees. And $39 billion collectively in fees that people paid. And again, most people living paycheck to paycheck, this is just adding salt to the wound, I guess, so to speak. $39 billion in junk fees, an increase of 34% when paying last year. So the credit card companies are basically raking it in on all this inflation because they get a percentage of the sales transaction price. And of course, the higher prices go, just like the real estate commissions, right? The higher the commissions, the higher the fees. All right, but moreover, a lot of these fees are fees directly from the credit card companies to the consumer and not transaction fees, late fees, fees just for having the card open, subprime cards charging like a yearly fee just to have the card, especially people that have a hard time getting a credit card. They're more likely going to pay and be willing to pay a fee just to have the credit card when they have limited options, right? Then, of course, you have late fees, over the debt limits fees, all kinds of different fees that people pay. And we also have a lot of changes happening in student loan debt forgiveness. In fact, a lot of student loan carriers of this debt, are really disappointed right now. They were close to getting this student loan balances waived and forgiven, and now they're completely revamping the way it is. And some people say, yeah, this is fair that they're doing this because people in the public sector had a easier time discharging student loan debt, and it was a lot easier for them to discharge the debt for the non-public sector workforce, right? And people said that's not fair. They shouldn't have favoritism, and it shouldn't be easier for them to forgive their debt or get their student loan debt forgiven. Other people say this is rude. Rude is not the right word. Other people say that this is cruel, that these people thought they were going to get their debt forgiven, and now they're yanking it back, like pulling the carrot away from the rabbit, so to speak. And I always think that it should be equal, right? That certain people shouldn't get benefits that other people don't get. I think it should be a level playing field, but of course, it's been unlevel for such a long time, where you see different groups getting certain benefits that other groups don't get. And I think the whole thing should just be level. All right, here's something that's back in the news. It's been happening for years now. We see these cities, and usually it's small towns in remote areas, are paying people to move there. Families are being paid $5,000 to move to small towns in states like Indiana to escape the cost of living crisis in big cities. This is what's so good about remote work. If you can work remotely, you can move to one of these smaller cities, get paid for doing it, and have a much lower cost of living than living in downtown Los Angeles or downtown San Francisco, where most of the jobs are. Most of the jobs are in the bigger cities. That's why we need more remote jobs. And that's why I was so upset. Not really upset. I was so kind of confused that they were calling people back to the office, right? You can, as an employer, you can keep a little bit better eye on people when they're in the office versus working at home. But if people are working on a computer all day, you can tell, just with technology, you can tell if they're actually doing something, if they're typing. And of course, you can have them send you reports on what they did. And if they're talking to customers on the phone, it's the same thing as you'd be sitting in a cubicle in some office building downtown somewhere. You're talking on the phone. So why not just do it at home, right? So it's a good thing that people are incentivizing, that cities are incentivizing people to move there. Families are flocking to the middle of the country, desiring affordability and community, and towns are welcoming them with cash in hands. Many Americans are sick of where they live because rising home costs, struggling education, healthcare systems, and dreams of a better infrastructure driving families. Also, the crime in these cities. I mean, look what's happening in New York. Another person got set on fire in New York City. Just insanity, folks. So I'm all for the move to the smaller city. I don't live in downtown San Diego. I live on the outskirts. I wouldn't want to live in downtown. Some people love downtown, especially the partiers, the people that like to go to the bars, the nightclubs and all that, the night scene. Anyways, hope you guys are having a happy St. Patrick's Day. And again, forgive me for not wearing green, but at the beginning of the video, you know what it celebrates. You know where it originated from. So are you going to wear green now that you know that? Or maybe you already knew that. Do you not wear green because you know where the holiday originated? Or are you just okay drinking green beer and looking at the Green River in Chicago? Waste of money. Anyways, keep stacking, folks. What do you guys think about all this? Those billions of fees that people are paying to credit card companies. The stock market weakness is going to be a recovery this week, right? We're going to find out. Fed holding rates steady. What do you think about that? Consumers starting to crack according to CNBC. Folks, it's about ready to get even crazier. Keep stacking. As always, make sure you're subscribed right down here. Smash that button for us. Like and subscribe, people. See you soon. Keep stacking. Bye for now. Peace.